Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Amkor stock so we can determine if it's a buy or a sell. Amkor is a semiconductor company that designs, packages, and tests integrated circuits for chip manufacturers. It has factories in China, Japan, Korea, Malaysia, Philippines, Portugal, Taiwan, and Vietnam. The company is headquartered in Tempe, Arizona, and was founded in 1968. The ticker trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 5.8 billion market cap. They're trading at $24 a share, and they have 242 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow each year. It's not too big. It was highest in 2021 at 342 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows steadily from 120 million to 770 million. Revenue is the sales for the company, and that also grows about 1 billion each year, from 4 billion up to 7 billion. Let's look at the capital structure. They have 3.7 billion of equity, 1.4 billion of debt. They're 73% equity, 27% debt. And their net debt is only 138 million, so they can pay off almost all the debt with the cash on the balance sheet. I use the middle whack on Finbox, 11.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 4.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.2 billion. We divide that by 242 million shares. And we get a calculated stock price of $17. They're trading at $24, so they're trading at a 39% premium. It's a sell according to the model. The website Simply Wall Street is on another planet. Their valuation is 123. They're saying it's 81% undervalued. Only one analyst priced this stock, and their price target is $35. This is where the stock has been trading the last 5 years. So you can see at about the end of 2020, they started paying a dividend. And they've been paying it consistently each quarter. Their stock price really started to blow up in the very beginning of 2021. To start the year, they were at $15, and in 2 years, they doubled their stock price, over 30. It has come back down a little bit, but trading much higher than what it was pre-2021. Once they started paying a dividend, then a lot of people bought the stock, because there's certain investors out there that will only invest in stocks that pay a dividend. So when you do not pay a dividend, you can't attract those investors. They started out with a 4-cent dividend in December 2020. They upped it to 5 cents in December 2021, then upped it to 8 cents in December 2022. It's only a yield of 1.25%, so it is affordable. It's 38% of their free cash flow, 9% of their net income. There are 62 companies in the same industry as Amkor, and if Amkor has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do have a lot of factories, so they do a good amount of manufacturing, but they are a small company, so their capex is lower than average at 900 million. Average is 1.6 billion. Because when you have these giants like Taiwan Semiconductor at 35 billion capex, it just really drags up the average. And TSM is the largest foundry in the world. At one point, their market cap was higher than Nvidia, but Nvidia has come up a lot the past several months. Nvidia is the largest fabless company in the world. Fabless are companies that don't do the manufacturing. They do have a good debt to equity ratio, a lot lower than average. Their dividend is in line with these other companies. They don't generate too much free cash flow. They rank 26th in market cap. Average is 41 billion. They have really good ratios. Their price to free cash flow isn't much better than average. The reason Nvidia is 100 is because I capped this number at 100. Because if I let it get too high, it would really skew the average. But Nvidia's price to free cash flow is actually 182, so it's extremely overvalued. They do generate a lot of revenue, 7 billion. Even though it's lower than average, it's a lot relative to their market cap, because look at their price to sales ratio, 0.8, much better than the average. Price to sales is market cap over revenue. Their 5-year annual revenue growth rate is a little better than average, and they have a good ROA and ROE. To summarize, I have them trading at a 39% premium, and I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.